Let's talk about the vertical spread option trading strategy. The vertical spread is the most basic spread you'll learn about, and it's the building block of the majority of more complex option spreads you'll learn about in the future. So make sure you pay close attention to this video and even rewatch it a few times if you have to, because understanding the vertical spread is going to be key to understanding all of the other option spreads you'll learn about later on. So first, what is a vertical spread? Well, it's simply the combination of a long option and a short option at different strikes, but with the same expiration date. So when you trade a vertical spread, you're simply trading two options at once. But we like to think of it as one trade, and the trade is collectively called a vertical spread. Now, we can buy or sell a vertical spread as an opening trade, and I'm going to explain both examples to you. But first, let's talk about selling a vertical spread as an opening trade. In an earlier video, we talked about how you can sell options to collect time premium, because we know that if an option is out of the money at the expiration date, it will be worthless. So let's look at a real example. Netflix stock is trading at $93 per share, and we don't know where the stock will go, but we would like to bet that it won't go over $100 per share. You could of course sell the 100 strike call option for, let's say, $3. And if this option remains out of the money until the expiration date, meaning that the stock stays anywhere below 100, then we would get to keep this entire credit received as profit, and it makes a lot of sense. However, there are a few problems with this that keeps the majority of traders away from selling premium. Number one, we don't know our max risk. Netflix could skyrocket and blow right through the 100 strike. Number two, the capital requirement to sell this option could be very large. So what can we do to combat these two problems? Well, in addition to selling the 100 strike call for $3, we could also simultaneously buy the 105 strike call for, let's say, $1.20. This is called a short vertical spread. By trading a vertical spread rather than selling just a naked option, we are able to sell time premium but with very little capital and also with defined risk. So how exactly does this trade work? Well, let's think about three different scenarios. Scenario number one, Netflix stays below $100 per share. Now, we already know that if an option is out of the money at the expiration date, it will have no value. And if the stock is below 100, then that means both of our options that make up our vertical spread would be classified as out of the money and are worthless. That means we made $300 on the short 100 strike call, but we lost $120 on the long 105 strike call. So our net profit is $180. And that's how we look at it. We don't really care about each individual leg of the trade. All we care about is our net profit of the vertical spread as a whole. And actually, once you understand vertical spreads and start trading them, you probably won't even look at the prices of each individual option. You'll simply monitor the price of the entire spread itself, and I'll show you how to do that at the end of this video. Now, in this scenario, we don't have to do anything with this trade. We can let these options expire worthless, and they will disappear from our account, and we won't have to pay any commissions to close it. Or, if you'd like, you could also close the trade anytime prior to expiration. Now, let's check out another scenario. Even though there's only a 1% chance of it happening, let's say Netflix stock decides to go nuts and ends up at $130 per share. Let's break it down and see what each individual option price will be. Our short 100 strike call that we sold for $3 is now 30 points in the money, so now it will be worth $30. If we sold this call naked, that sucks big time because that means we lost $2,700, but fortunately we traded a vertical spread instead of selling the naked call. Our 105 strike call that we bought for $1.20 is now 25 points in the money. So even though we lost $2,700 on the short call, we made $2,380 on the long call. So our net loss is just $320. Now again, we aren't really concerned about each individual leg of the trade. The loss of $320 will be the same whether we're at 130 or 190 or any other number above $105 per share. If we are above $105 per share, the net price of the vertical spread will be worth the difference between the strike prices we chose when we opened the position. The difference between the strikes on this example is 5 points. So in absolutely no situation will this vertical spread ever be worth more than $5? If we sell the spread at 180 and close it at 5, then we lost $320. Okay, so last scenario. What if the stock ends up between our short and long strikes of 100 and 105? Well, in this case, the 105 strike call will be out of the money and the 100 strike call will be in the money. So the 105 call will be worthless and the 100 strike call will be worth the difference between the stock price and the strike price. If the stock is at 101, for example, then the vertical spread as a whole will be worth $1. And of course, if we sold at 180 and closed it at 1, then we made $80. But where do we break even? Well, we sold this vertical spread for $1.80. So our break even is 180 plus our short strike of 100. So if the stock is anywhere below 101.80, we'll make money, and if it's anywhere above 101.80, we're going to lose money. I'm going to show you some real trade examples in my trading platform, but first let's recap a bit. When selling a vertical spread, our maximum profit is simply the net price that we sell the vertical spread for. In this case, we sold the vertical spread for a net price of 180, so our maximum potential profit is $180. And by the way, you can also see this on the chart in the bottom of your screen. The x-axis, or the horizontal axis, represents the stock price, and the y-axis represents our profit or loss. So that's represented by this blue line. Our maximum loss is the width between our strikes of our spread minus the price we entered the trade for, which in this case it came out to be $320. And by the way, this is also your capital requirement for the trade. And finally, our break even is our short strike plus our net price we entered the trade, which is 101.80 on this example. I know this may sound like a lot to remember, but the cool thing is that all of this information is automatically calculated and given to us by the Thinkorswim platform before we send our order. And you may be wondering why anyone would take a trade where you are risking more than you can potentially make. The reason is because it allows you to achieve a very high probability of success and profit without having to predict stock prices. Risk to reward and probability of success are directly tied to each other. Now let's check out a few real examples in my trading platform. So here we are in the Thinkorswim platform, and the cool thing about trading spreads is that the technology is advanced enough to allow us to enter the multiple options that make up the spread as one order. So we're looking at the option chain of SPY, which is the S&P 500 ETF. All we have to do is right click any out of the money option, and in this case we're going to do the call side and right click the bid or the ask and then click sell vertical. And you can see it pulls up an order and it defaults to one strike wide. We can now adjust our strikes to whatever strikes we want, and our short strike, the one we are selling, would be our strike that we want the stock to stay below. Now we can select our price, and since we are selling this vertical, we would want to get filled at a higher price. When trading spreads, the default is the mid price between the bid and the ask on both options. So use the mid price as a guide. The closer to the mid price that you can get in the trade, the better. And this is why we stick to only liquid stocks in our Skyview watch list that you'll find on our website. So now that we have our price selected and our order pulled up, now we can go ahead and click confirm and send this order. Also, our example involves selling a vertical call spread, where we would want the stock to stay below our short call so we can keep the credit we received for the trade. Well, we could also do this with the puts, where we would sell a put and then buy a further out of the money put as protection. In this case, we would want the stock to stay above our short put strike. So a short put vertical would be a bullish to neutral trade, and a short call vertical would be a bearish to neutral trade. The key here to remember is that when selling a vertical spread, whether it's calls or puts, we want to make sure that we are selling the closer to the money, more expensive option, and we are buying the further out of the money, cheaper option. If you use the Thinkorswim platform to construct your vertical spread, it will default to this for you. So alright guys, hope you enjoyed the video and learned from it. If so, be sure to click the like and subscribe button below, and also check out our website and join our email list for 3 exclusive free videos. And I will see you in the next video.